Gold goes up to the old normal eightfold high,
Mm-hmm.
which is what? 8,000 plus in price. It would
Mm-hmm.
be where it was in 2011, where it was in 1980 in terms of dimension of move. Okay. Do 3.5% of 8,000. Okay. Well, in the couple hundreds. Okay. Yeah. So the point is that major lids are coming off here, not merely price chart stuff.
The recent shift in relative performance between precious metals and equities is sending a loud signal that a major transition is underway. Gold has decisively moved ahead of broad stock indices after spending more than a decade trapped in a sideways relative range. This kind of long-term breakout rarely resolves quickly or quietly because it reflects a structural change in where capital prefers to sit. When gold begins outperforming equities across the S&P, Nasdaq, and other major indices at the same time, it suggests that institutional money is quietly rotating away from financial assets and toward monetary protection, not for a short trade, but for a longer cycle. Michael Oliver emphasizes that this transition does not happen by accident or because of retail enthusiasm. The breakout in gold relative to stocks implies that larger, more informed capital is repositioning in anticipation of economic strain and equity market fatigue. Historically, such shifts have coincided with topping processes in stocks, where prices appear stable or even make marginal new highs, while internal strength erodes. During these phases, markets often lull participants into complacency before a broader repricing takes hold. Gold's relative strength is acting as an early warning that the balance between risk assets and defensive assets is changing in a meaningful way. The more dramatic development, however, is unfolding in silver. After spending decades failing to match gold's long-term progress, silver has finally pushed beyond a range that defined its entire modern trading history. According to Michael Oliver, previous silver cycles show that once these massive ceilings give way, the move that follows tends to be compressed in time and extreme in magnitude. Silver has now begun outperforming gold itself, a condition that historically preceded rapid advances measured not in years, but in months. With momentum and price both confirming the breakout, the message is that silver is no longer lagging. It is entering a phase where revaluation can happen fast, forcing markets to confront price levels that once seemed unrealistic. Now, we present the clips from Michael's interview with Capital Cosm. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you and enjoy the video.
That's current action there.
So that takes it around 10,000 or close to 10,000?
No, it's about 8,500.
85, okay.
Each of those first moves, the 76 bear low, which was a correction from $200 down there, 100. Summer of 76, you went from that low near 100 to 850 in that first move. Eightfold move, 8 times the bear market low. Okay. Then you made a low in 2001 in price, and you multiply that times about 8, and what you got? The 2011 high. Another 8-fold move. No, on an arithmetic scale, it would be far more dramatic, but on a ratio, logarithmic scale, which how much did gold go up in multiple? 2 moves of 8-fold dimension. If you measure from the bear low in 2015, which was $1,050, it says, well up in the 8,000s. And then finally, you'll have only matched what you did twice before. Hardly a headline. I've done it before twice. It's probably going to go way beyond there. But people who think that gold is overdone, right now we're only 4-fold. So it doesn't compare to the dimensionality of the price changes 76 to 80, 2001, 2011. We're only halfway there. So that's something to pause and think about. Yeah, on an arithmetic scale, you look at the action the last 6 months or so, you say, I got to take profits. Yeah, right. Okay, fine. Do it if you want to. But meanwhile, gold just broke out above the biggest stock market in the world and says, I've just now begun to beat you. Just begun. Well, okay. Anyway, then the real issue for us right now is not gold. Everything there is positive. It's been positive for us since 2016, but it's silver. And this is the same 50-year period of time. Ratio scale again. And you can see that the low end of that rectangle is like it's about $4 back in 1993 and also in the mid 70s. And you shot up there in 1980 to $50. Okay. It was a little bit better move than that first gold move. Gold went up 8-fold. Silver went up about 10-fold during that multi-year move, with a lot of it compressed in the last 6 months of that move where you really exploded. Okay. Then you went sideways for decades. And then in 2011, again, with a spurt in the last 6-7 months of that move, that's the second ellipse there. Then you went up to 50 again. Okay. And meanwhile, gold's blasted way above that first high, right? Okay. Yep. Eightfold. Silver's the same fold over and over. Okay. Then you come back down again in silver, mid-range this time, based. And now you've punched through. That last reading is $62. We're now trading at about 65. This is as of a week ago. But you finally punched out of that range a bit. Now, that's a price chart. We look primarily at momentum, and momentum has already said you're going to leave the earth here. Okay. Price now sort of says, oh, me too. Okay. But if you take the dimensionality of those first two swings, which were redundant in the case of silver, and swing it up and say, okay, I'm going to match the logarithmic scale dimension of that rectangle. This is $500. This is log scale, remember. So 500 would be about where that arrow top is, that third arrow, the second arrow. That'd be about $500. Now, that's crazy, right? Yeah, okay, well, maybe it is. Silver, how come silver didn't do what gold did for 50 years? It moved with gold, but it didn't move in the dimensionality that gold moved. One reality, a new reality, now a third reality. Silver's just broken out of the very first reality. Well, there's arguments for that, why it occurred, There's something that happened back then in that first ellipse and the second ellipse. There's just price charts here. It wasn't the momentum of price that said something, because already at that point in time, you were well into a bull trend, as you can see. They were already going up nicely before you got into that sharp ellipse period there. When we measure silver, ounce of silver divided into an ounce of gold, we create a spread chart. A lot of people look at ratio. We do it another way. An ounce of silver into an ounce of gold. And at those points in time, prior to those 6 or so months of verticality, the spread chart of silver versus gold broke out over a nice, clear ceiling. So if you were only looking at silver versus gold and plotting it as a percent, you would have seen, you could have plotted a chart where there was a ceiling, you broke out. And when you broke out on the spread, that's when silver said, okay, I'm unleashed versus gold and versus net price. We broke out of that same spread that gold broke out above the S&P in November. Silver broke out versus gold at the close of November. Where was silver then? I think it was the mid 50s. Okay. Already, since the close of November, we're in the month 1 of the countdown. Let's assume we got like 6 months either way, 5, 6, 7 months to do a surge like we did in 79 or late 2010, early 2011. Extreme compression squished into a couple quarters where you go ape, okay? The spread told us back then at both those times. It's now telling us now, you just, not only are you breaking out above this range, which means getting above 50, but the spread broke out over a massive horizontal structure. So we have a silver gold breakout saying, nope, don't buy gold, buy silver. It's going to catch up. Well, again, if I do a ratio of this, we're talking a crazy number, right? Maybe it's not. There's one chart I want to show you that shows these events happen. They're rare, but they're not exclusive to special markets. And that's the copper and lead charts. We put out this report in late October. At that point, silver, by the way, was $48 just to make it. We were trying to show our subscribers this is a history of the price chart of copper. And below, we'll look at lead in a second. But see that first low rectangle? Actually, you could go further back. Instead of the 90s, you go back into the 70s and see the same range existed up and through mid-2005. So many decades of up, down, normal reality for copper. The red ellipse took place over a span of a couple quarters. You quadrupled the price of copper between there and about 2007. Very quickly. And then look at the new range that existed since 2008. Yeah, there was a sharp drop after that. But look, the average range up there is like $7,000, $8,000 per metric ton, but about 4 times the average range that existed back in the 70s, 80s, 90s, 2000s. So copper broke out into a new reality, and it didn't take it 3 years to get there. Look at a couple quarters. There was no headline. Okay, scroll down, now you see lead, another exciting metal. Okay. Same range-bound situation, going all the way back to the 70s. Its breakout occurred in 2006-7, not the same time as the copper move. It wasn't a base metal explosion. Lead was firming up, but it didn't really go ape till that red ellipse. Okay. You went from an average price in that range in the 70s through 2007 of about, let's call it about $600, the average price. And you went up to 3,600, and most of that occurring in about 6-7 months. Again, not not in sync with copper. It's its own thing. And then it dropped, but then look what happened after that. You went into a new reality, multiple times more than the average reality. How come silver's in the old reality? We know we have a supply-demand problem with silver. 5 years in a row, consuming more than we got, and there's not much capacity to really increase production because most production does not come from silver mines. It comes as a secondary product of the base metal mine, which means you can take the ounce of silver up sharply, but it's not necessarily going to impact the guys who manage a copper mine because it's too marginal in their overall production to increase production just to get some more silver, to get the point. So it's a very unique position. Plus, we got a bull market in gold, and silver moves to monetary metal, and it's undervalued, and therefore it could go ape. It's happened before, not just copper, lead. I could have thrown darts at half a dozen other markets, bread prices or something.
Silver is now emerging from a prolonged period of stagnation, breaking decisively above levels that have contained it for decades. The recent breakout against gold signals that the long-awaited catch-up phase may be underway, with the silver-gold ratio pointing to potentially dramatic gains. Michael Oliver emphasizes that such moves are rarely incremental. Historical patterns in silver and other metals show that once a major horizontal resistance is breached, prices can accelerate quickly, often in a compressed time frame of just a few quarters. The past decades of sideways action, combined with constrained supply and steadily growing industrial and technological demand, create a setup where silver is positioned to surge, catching up to gold and possibly redefining its valuation landscape. The potential for rapid upward movement is reinforced by comparisons with historical peaks, including the 2011 bull market highs, where silver achieved multiples relative to gold that far exceeded typical market expectations. Michael Oliver notes that, if silver were to reach just the lesser high of that period relative to gold, it could effectively double or even triple from current levels, translating into a surge toward the $500 mark if gold follows its expected trajectory. This suggests that silver is entering a phase not only of catching up, but potentially of exceeding past expectations, driven by a unique convergence of supply limitations, industrial necessity, and monetary pressures, a perfect storm for a historic repricing event.
November's close, gold relative to the S&P 500. Back in 2011, gold was, nice high levels in price and also outperforming the S&P. And then it started to collapse big time in 2013. That's when gold really started to come apart. And it kept going down through 2015. We're not looking at a price chart now. We're looking at price versus price, top chart. We divide an ounce of gold into the S&P 500 price, express the answer as a percent. And you can see in 2015, that first major drop halted just above 50%, meaning an ounce of gold was about 50% the price of silver, of S&P, excuse me. And he had a bounce, and he came down again in 2018, made a low near 40%, and had another big bounce, outperformance of gold. That was that 2020 rally. Remember that the gold shot up about 40%. Yep. Silver doubled in that time. So gold outperformed the S&P, but still it didn't have a structure, if you know what I mean. You'll see in a second what the structure is, the green line. Came down again in 2021, built a base for a couple of years, and it broke out of that base in early this year. You broke up out of that couple of years of horizontal action that peaked at around 48%. You'll see multiple peaks there. And you exploded. Where did you go? You came up to the green line. This is in April of this year. That's when gold was 3,500. The spread reached almost 60%, and they hit it again, which tells us our green line is a good line. It's very valid because the market responded to it again. November closed over it. So that says you've got an 11-year wide basing range of gold relative to the S&P where it does better, does worse, does better, does worse, but basically sideways for 11 years, either side of, let's say, 50%. You just broke out. Now, if this were a price chart and I dropped it on your table in front of you and wiped out the title so you didn't know what it was, it said, look at this chart, you'd say, gee, I got to buy that beast, right? Okay, yep. Fresh breakout. Well, this is a fresh relative performance asset class shift saying, yeah, gold's been doing better than the S&P for the last year, but it's really going to do better now. You just cleared a major base. And then when we go to the strongest index in the S&P over the last decade especially, it's Nasdaq 100. And even versus it, and these readings are as of last, they're not up to date. It's a little higher now. Broke out also. And when we go to the Dow, which is in this, the Dow 30 or it's not in this anyway, the Nasdaq, the New York Composite, They broke out months ago. Gold broke out versus them. So versus any stock index you want to throw up there and say, should I own the stock market or gold? None of them are beating gold now. They've all just been broken out above. And it's the start of something big. You don't break out of something like this and go up for a month or two and fail. This is just the beginning. The economy is going to weaken probably with the stock market. It almost always does. We think the stock market is in a topping process. It has been since early this year. By that, I mean price hit a level at, S&P got the 6150 area, I think it was, early in January, collapsed down to April low, then came back up through the January high and has reached up to the 6,900 level. So about 10 or 12% beyond the early high. But I think it's still part of a laboring process, a topping process, which is very similar to the year plus wide action we had in 2000 when the market topped, and 2007 when the market topped and it came up, made a new high marginally, cheered everybody on. And then it took it a whole year or so of distribution for it finally to roll over and start the bear trend. It wasn't like the floor came out instantly. No, it was a laborious process. And already gold is saying, hey, it's really just begun. The gold strength versus S&P, or you can put it the other way, S&P weakness versus gold. It's just begun. So we suspect at MSA that probably the stock market is still going to be laboring for another couple months, possibly with a marginally higher high than we've seen the last 3 months. For example, S&P saw 6,900 3 months ago, and then again this month. It might go up and hit 7,000 to ring a nice number in, make everybody happy, and take that out. I don't think it's going anywhere on the upside of any significance. So far, it hasn't for about 3.5 months, by the way. It's been mostly lateral. And probably sometime in the second quarter, you're going to see stock market weakness that people will call weakness, whether they're upset by it. But meantime, I think it's going to be a boring, languishing effort by the stock market to hold. But meanwhile, gold is soaring compared to it. So money is starting to shift. If somebody's buying gold over the S&P, otherwise that spread wouldn't have broken out. And it's certainly not the average American investor. We know that.
Many analysts now anticipate that silver is on the brink of a major surge, driven by a combination of macroeconomic forces and market fundamentals. With central banks continuing loose monetary policies and inflationary pressures persisting across major economies, investors are increasingly turning to tangible assets for security. Silver, with its dual role as both an industrial metal and a monetary hedge, stands to benefit from this shift. Analysts point out that money is gradually moving out of paper assets and into precious metals, suggesting that silver's upward momentum could accelerate sharply. On the supply side, silver faces structural limitations that could amplify this rally. Most silver is produced as a byproduct of other mining operations, meaning higher prices cannot quickly generate proportional increases in output. At the same time, industrial demand for silver is rising, particularly in technology, renewable energy, and strategic applications, creating a widening gap between supply and demand. Analysts project that these pressures could push silver above multi-year resistance levels, with the silver-gold ratio tightening significantly as the metal attempts to catch up to gold. With these dynamics converging, the market could see a highly compressed surge in price over just a few months rather than years. Could this unfolding scenario mark the beginning of a new era for silver, where it finally asserts its full value against gold? Share your thoughts in the comment section below. If you found this insight useful, make sure to like, share, and spread this update to others watching the silver story unfold. Your support helps keep these deep dive analyses coming.